Welcome to the Real Estate Women's Podcast. Thanks for pulling up a chair to our roundtable discussion. Here, we'll teach you how you can create a stream of passive income through multifamily investing, and we'll help you to shift your mindset so you can start living the life you really want to be living by design today. Hey guys, we are the Real Estate Women, and I'm Crystal.
I'm Candy.
I'm Colleen. And I'm Tamara. Welcome to the Passive Investing Podcast. In today's episode, we're going to talk about underwriting, how you should look over a deal and determine it from underwriting if it's a good or bad investment.
Hi, Craig. Welcome to the podcast.
Hi, ladies. I'm happy to be here.
Thank you so much. So Craig has spent the last 20 years in the high-tech industry working in intelligence, analytics, and program management. And most recently, he joined Creed Capital as their Director of Operations and Acquisition Specialist. Craig has been investing in real estate for 5 years. And in addition to investing in real estate, Craig has leveraged his experience to develop a set of underwriting tools to help multifamily investors like us analyze and research investment opportunities. Craig, thank you so much for coming on, and none better to talk about underwriting when you really have to understand it if you have written a program to help you navigate the numbers and make it all work together. So for all of our listeners out there, this is one thing that a lot of people, they see the numbers, they want to understand what they mean. The returns can be very appealing, but it's really important to understand how they all interact and how they work. So, but just for the basics, sometimes people don't even understand what underwriting is. People refer to it all the time. Can you kind of describe what underwriting is for our listeners?
Yeah, so in simple terms, underwriting is just analyzing a deal to see if it makes sense to invest in. And there are lots of inputs that go into underwriting, right? So when I was in the single family house days, I was looking at one property and I was trying to figure out how much income that property would make and how much income or how much I would have to spend to get that property in shape. Multifamily is like that, but infinitely more complex because you have a lot of units, you have a lot of moving pieces. We get a lot of data from the sellers that we have to process and analyze to determine whether or not the deal makes sense.
And for the numbers that you put in, where do you initially start off with what the seller is presenting to you? Are there ways to like how when those numbers go in, how does that like set the underwriting to move forward? Like, can you explain like what that does when you enter them? Where do you go from there?
Yeah, so I'll kind of explain to you the process that we go through. So it's kind of like peeling an onion, right? So first thing we get is an offering memorandum in most cases for an on-market deal. And that offering memorandum is the broker's best case scenario. He's outlining the deal. And you always take it with a grain of salt because chances are it is exactly that best case scenario. But we look at that to see if it meets our criteria in terms of age, location, size. And then we decide if we want to kind of proceed forward with some kind of underwriting. So underwriting, I would say we can evaluate a deal very quickly at a high level in about 10 minutes. And then we kind of decide if we want to move forward, and then we evaluate it, spend another 30 minutes digging into some of the details. And then I go through that process multiple times before we actually go through in issuing an LOI or an offer. But the data we look at is a lot of times with an offering memorandum, we'll get a rent roll. So we can see exactly how the property is performing, what rents they are getting versus what we think they could get in the market. And then we'll get a T12, which is a trailing 12-month of the income and expenses at the property by a line item. So we can see how the property has trended. We can see how their debt default is, how their collections are, what rents they're actually receiving, some of the other income items, and how their expenses have trended. So we'll do a deep dive in all the expenses to make sure that they all make sense. And then we port that into the underwriting model, and we're able to do our analysis to say, well, this is where the property is today. This is where we think we can bring it to after either a renovation or some operational efficiencies. And then we run it through the model and see what kind of returns it can generate for us and our investors.
Perfect. Thank you. That was a really great high level explanation of that. And I think a key takeaway for the listeners that they should realize is the two things there. What the property is doing right now, that has to be brought out from real, true, actual numbers. And then what it could do, that is going to be the sponsor or the lead of the deal. That's going to be their educated guess on what it could do. So for a passive investor, this is where you have to do your due diligence and start asking the right questions on the right line items to make sure that sponsor to the deal isn't inflating things or isn't being too dramatic or isn't saying that they can achieve the world for nothing. So
Right.
when it comes to that, Craig, what do you think are, what are some of the easiest and biggest red flags that maybe if you've looked at somebody else's underwriting and you can say, oh, well, that's super unrealistic. That just can't happen that way. What are some things that our passive investors could really be on the lookout for when it comes to some of those important numbers? What would you say?
Yeah, I can probably give you a list of 40 things.
Yeah.
But yeah, in the highest sense, right? So first of all, you got to trust the sponsor, right? So understand the sponsor, understand their track record. Ask them about the assumptions that went into their underwriting, because underwriting is a set of, hundreds of inputs, literally, and you can make a lot of adjustments to those inputs. You can make a lot of assumptions in your model to basically generate any output that you want, right? So understanding the assumptions that went into it. Some of the big assumptions that really affect underwriting are cap rates. So this is a capitalization rate. It's basically the measure of the return that the property can produce based on the purchase price without any debt or financing in place, right? So we kind of look at cap rates to evaluate properties side by side, kind of gives a level playing field. Underwriting models are hugely sensitive to cap rates. So they greatly affect the output, especially in the IRR metric. So it's really important to understand the cap rate assumptions that they're using and how that relates to other similar type assets in the market that they're purchasing the property at, and what their cap rate assumption is in the future, right? So it's common practice to take your cap rate and escalate it a little bit every year until you exit that property. So understanding how they're escalating their cap rate, what their assumptions are for the cap rate over time. I would say the other things I tend to look at are financing. What kind of financing are they getting on the property? This can have a huge impact. And depending on the level of risk they're willing to take on with the property, right? So there are certain financing options that are more risky than others. I would say a lot of people that took on bridge debt, which is a variable rate debt, the last couple of years, and now that rates have increased pretty substantially. That means there's a very likely a huge increase into the debt service of that property, which could affect returns, right? So understanding their financing assumptions. And then I'd say the other thing that I'm really sensitive to are rent growth, right? So in a lot of markets that we're looking at, we're seeing rent growth taper off and even a little bit down year on year. So understanding what their rent growth assumptions are, especially in year one. Year one has an outsized impact on the rest of the model. So what are they forecasting for rent growth in this year that's separate from the renovation strategy that they plan to implement? Like, what is their rent growth assumption? I'd say those are the really big things that I tend to look at. And then just generally speaking, what I would like to see is like what's in place today. So I think this gets left out of a lot of OMs that I see or investor presentations. It's like, where's the property today in terms of income, expenses, and net income? And where do you expect to get to in year one? Because if they're forecasting like a 30% net income growth in year one, that's probably a red flag, right? 10% would be good, especially if there's a big renovation going on in year one. You're not going to get a huge net income bump until that renovation is played out in 1 or 2 years. So that's also a big red flag. If I see really huge year one net income growth, I'm going to ask the questions, understand that assumption.
So, Craig, just for those listeners that, for the first time of hearing cap rate,
Yeah.
that's a complex. It's not a complex, but yet it is, and it really is something that is very important into understanding the underwriting. So, could you touch a little bit more? Like, so if I'm looking at a deal, is there a relative relationship to growth, and does the cap, just if you could just break down give a bunch of examples in like layman's terms so people to understand. So does cap rate grow as a property grows? Does it is the opposite? Like, how does all this work so that if I don't really have a complete understanding of the term cap rate, how could I look at something after listening to this podcast and say, okay, so relatively it's moving in this direction and that direction as we're pivoting? Because you can evaluate a property with your due diligence that you've done on the area and the numbers that we just talked about, and have a not complete understanding of cap rate at the same time, because it's a complex issue.
Yeah, cap rates are kind of, I'd say when I started underwriting multifamily, I think that was the biggest thing that I struggled with was cap rate. And it's not because the calculation's difficult, it's because there's some subjectivity to cap rates, which I found challenging because I'm more of a data guy. I want like yes or no. Like I don't like subjectivity in that. But as you start to underwrite deals in specific markets, you get a better feel for what's going on with cap rate. But in simple terms, cap rate really is the net operating income divided by the market value of that property gives you a cap rate. So if I have net income of $10,000 and my property is worth $100,000, that's a 10% cap rate. Similarly, we also use the cap rate equation to determine what the value of the property is, right? So if I have property that's producing $10,000 of income a year, I could divide it by the cap rate and then get $100,000 would be the value of that property. So this is how we use cap rate. So what we do is we'll trend out our pro forma, our discounted cash flow, and we'll say we want to sell in year 5. This is what my net operating income is divided by the cap rate, and it will give me my value. So determining that cap rate, right? There's some subjectivity over what you think the cap rate is going to do in the future. And so a conservative rule of thumb is that most operators will escalate that cap rate. Though we can tell what the cap rate is today because we'll have our purchase price and we know what the in-place income is at that property, and we could devise a cap rate, right? So like a 5% is a kind of a common cap rate right now. And so what we could say, well, let's say we're going to increase value of that property. We're going to increase the net operating income of that property over 5 years. We started with a 5 cap, but I'm going to escalate that cap maybe 10 basis points a year so that when we sell, I'm going to use a 5.5% cap rate. It's a little bit more conservative. We've been seeing cap rates compress for a long time. We're starting to see them kind of creep back up a little bit. Nobody really knows what the future holds, so it's more conservative to go ahead and increase that cap rate over time. But it's still kind of cap rates are very unique to the location of your property, the type of asset class you're looking at. Because if you have a nice Class A asset, which is like brand new, top of the line, everything, you're going to have a very small cap rate because there's not going to be a lot of risk associated with that property. If you have let's say a C class asset, so 1970s-ish, kind of needs a lot of work, there's a lot more risk, and then the tenant base is more likely to default, things like that. So things that you have to consider. There's more risk associated with that type of deal. So you would expect the cap rate to be a little bit higher on that. So you want a better return on a riskier asset. Does that help?
And so a cap rate it only is in relative to the income and the price of the property.
Yeah.
And it has nothing to do with let me see if I can word this correctly. Don't look at a cap rate and see the difference between the starting and exiting cap rate and think, oh, that's great. There's so much distance between the two. That's a great property to invest in. Would that be a correct to not do that?
Yeah, not that alone, right?
Yeah.
It's really important to understand
Uh-huh.
uh, how they arrived at the cap rate for today. So, like, did they use the income of the property and the purchase price to figure out their market cap? Or, I mean, sometimes if you get a great screaming deal on a property and you know you're buying it below market, um, it's going to adjust that cap rate because you're getting a good deal. So you really want to know what's going on in the market for the asset that's located in. And
Mhm.
so what are similar properties trading for? What are the cap rates? And you can get that information through various sources. So a lot of operators will use either Crexi or CoStar. There's third-party sources that kind of aggregate sales data to kind of provide guidance in cap rates. But there's a little bit of subjectivity because it really depends on asset class location. And like I said, because of this um, relationship of income and cap rate and price, a tiny little change in cap rate, like a 10 basis point from like 5 to 5.1, can have tremendous impact on your exit price. So it's really important to like dial it in. And there's no exact science, unfortunately, for cap
And
rate.
I
It's
think to
taking into
kind
consideration all the factors that you have.
Perfect. And I think to kind of answer your question too, Candace, like for the LP investor, what their thoughts should be when they see a 5 cap on exit and a 5.5 on exit on a 5-year hold. The only thing that could really tell you is that, well, they are being conservative when it comes to the cap rate. That's what the LP investor
Mhm.
would see out of that. So that is definitely good. That can be one of the big checks. Okay. That looks like they're being conservative, but to Craig's point, how did they come to that 5 cap rate in the beginning? Is the really important, and remembering it's
Mhm.
market subjective. So if you're looking at an A-class asset in yeah, I don't know, Texas versus Boston, that could be a completely different cap rate, despite the fact that they could be the same asset class. So it is important to maybe go to that operator and ask, how did you come to that?
Yep,
Because they should have an answer for you, right? Craig, did I miss anything important in
that's
that?
perfect. Yeah, very well said. Yep.
Cool. And one other thing I think that would be good for the kind of maybe the listeners to think about too. One thing that you mentioned when it comes to the rent raises and the increased rate for that first
Mhm.
year. Um, Definitely remember for an LP, maybe you think they should ask things like, well, are you including vacancy rates? Because if they're saying, well, we're going to turn over 50% of these units, but their
Yeah.
vacancy rate is at like 4%. Well, that's a super unrealistic thing. There's a big red flag there because you can't have a 4% vacancy if you're turning over all of this in year one. So those are
Yeah.
some little things like Craig mentioned. That year one is really where a lot of the levers can be pulled. And coming back kind of to that year one P&L view, that line that they're looking at that says all the year one stuff they're going to do. Um, Other than things like that vacancy rate, is there another big one or big thing that someone could look at and say, well, that's just not a realistic number, or any other little, like, I guess, red flags that you see a lot in that?
Yeah. So, yeah, great question. Yeah. So vacancy in year one, really good question. So this was a big issue that I had when I started underwriting is the vacancy in a lot of models is just going to lump together. And so when I built my model, I separated out the renovation vacancy, and the model calculates my renovation vacancy based on my strategy, my timeline. So that gets plugged in, and then I can model my vacancy on top of that. So that super helpful to understand how much of your vacancy are you planning for renovation, and how much for just simple unit turns, right? Normal unit turns that you see through the year. But another one that is pretty big in a lot of properties, especially value add properties, is loss to lease. And so what this is, it's just saying your gross potential rent. So what is the maximum you could get if you had every unit at market rent with no vacancy, no issues, right? That is your maximum. And then what are you actually getting on the property based on your lease signing? So this is why I look at a rent roll so extensively, is because I want to see what they think their market rent is and what they're
Mhm.
actually getting, and that gap between market rent and actual is your loss to lease. And then a lot of value add properties that maybe are mismanaged or not really pushing the rents to market, there could be a very large loss to lease number. So it's always important to understand if there's a large loss to lease at the property, and what is the strategy to kind of make up that difference, right? Is it through the renovation that they expect to kind of bridge the gap on that loss to lease and get market rents up, or are they going to start pushing rents on renewals? But I've seen some underwriting where their loss to lease is really big in the T12 or the historical data or the rent roll, and then in year one it's like 4%, might be like 15%. So to go from like 15% loss to lease to 4% loss to lease would be really a big stretch in 1 year. And then the other thing kind of bundles everything together, right? So you have your gross potential rent, and then you have all these things that could take away from your rent, right? So vacancy, bad debt, loss to lease, renovation vacancy. So the way I measure this is through economic vacancy. So this one I look at quite a lot, right? So economic vacancy is just your gross potential rent minus all those income detractors to get to your effective gross income. So that difference is your economic vacancy. So if a property has an economic vacancy of like 30% in place, and they're expecting that economic vacancy to get to 10% in year one, that's a really aggressive schedule, right? So I tend to look at economic vacancy quite a lot because it kind of just gets rid of some of that noise between loss to lease and all those other.
So what would be a value, like a 5%? If you're saying 10%?
Yeah, it depends on what they're doing with the property. So if they're looking to just stabilize a property, and it depends on the asset class and all this stuff, right? But on a really nice Class A asset, maybe economic vacancy is close to 7%, 7, 8, on up to maybe like a 12, 13% for like the Class C. So somewhere in that range would be normal. If you have a really big renovation that's happening, let's say you have an operator that's going to renovate all the units in 2 years, I would expect that economic vacancy is going to be pretty high in year one,
Mm-hmm.
probably in year two as well, right? So we're going to see that probably 15 to 20% economic vacancy, I would expect. And keep in mind, if you have an operator that's doing a big renovation, we're going to see pretty low cash on cash returns during those years of renovation because they're pulling units off. There's a lot of vacancy. This economic vacancy number's high. But then when that property stabilizes, you're probably going to want to expect to see double-digit cash on cash return.
So this has been really good information to talk about, and like thinking about our listeners from the standpoint of attempting to keep it simple. Just what comes to mind is like the renovations and all that. It's kind of it goes back to like the know, like, and trust and the history of have they done this before? The renovation stuff to I don't want to say steer away from the numbers a little bit, but like to put that in the mesh of the underwriting that we're speaking of today, because that is really important. Do they have the right trades in place? So they have the right. Have they done this before? Like the rinse and repeat part of that portion, really, because the numbers, you can put any numbers on paper. It's what's the performance of that happening in the past.
Yeah. Yeah, I think just understanding the operator, right, the GP team, understanding their experience, talk to other investors that have invested with them, understand what their experience has been, I think is
Because
really
some of this, I mean, the underwriting part could be, a tad overwhelming actually for the listeners. So then that's, you need to have an understanding of all this, and that it's not just as simple as what's the rent and where are we going to, so that's, you really open that portion of the knowledge that we really need to bring to the table. So.
Mhm.
So when you're looking at the underwriting, Craig, for, let's say, as a limited partner, what are if you were just to be presented to it, your key numbers that you would look at first, and then obviously then take in consideration everything that Tamara has just described. to bringing it all together? What would be the key things that you would look at?
Yeah. As you could probably tell, I love to get in the weeds, right? So it's like, but yeah, so I attend pretty much every investor webinar that I can on deals just to kind of see how things are presented, see what questions kind of come up for me. And I think uh, there's a lot of different ways to present the data and it raises a lot of questions with me. So I think what I tend to look at, almost every operator seems to be offering like an 8 to 10% cash on cash, a 15% IRR return. So that's pretty much standard across any deal you look at. So how do you know if the deal you're actually looking at is good or not? And I think what I want to see is I want to see what their business. I want to see very clearly what their business strategy is, right? Like I just attended a webinar and I'm like, I had no idea what they were going to do. I knew they were renovating, but other than that, I had no idea what their costs were, how many units, what their assumptions were during the renovation, how long it was going to take up. So these are things that really have an impact. They never mentioned the cap rate. So I do want to know the cap rate. I think I cannot emphasize this enough. The cap rate has an outsized impact on the returns in the model. So I think it's critical to understand from your operator, like how are they determining their cap rate and what is their assumption for cap rate on exit and how did they come up with that logic? Super, super important. And then this is kind of an inside thing. Like the next two things that I tend to drill in on because it's come up a lot in my underwriting is what are their expense assumptions? We've seen expenses go through the roof in a lot of properties. Right. So rent growth we talked about, but expense assumptions, because we just got an insurance quote for a property that was $3,500 a door, which is insane, right? It's so expensive. So what are the assumptions for expenses? What's happening with insurance? And then the other expense that we have very little control over that is impacting a lot of properties are taxes. What are their tax assumptions? Have they done their homework on the tax projections, right? So what we like to do is we'll hire a tax attorney that says that they know what's going on in the local municipality and they can tell us, well, you can expect an increase. So have they done this homework on their taxes? Because I think some operators have gotten surprised by reassessments. So taxes are your biggest expense. Insurance is starting to become the biggest. The next one is usually payroll, but insurance is getting up there. So those are the things I look at. I don't know if that's super simple, but so I look at cap rate, expenses. I want to know, and renovation. What's their plan?
That's so funny. We were just talking about it too before you hopped on. We were just talking about the expenses, just talking about the reality of what insurances and taxes are really doing. Like we were literally just talking about it. So it's funny.
Could have a whole podcast on that.
Yeah, seriously. And this has all been, gosh, so great. And, I did have one other thing. If you could kind of elaborate something that you mentioned, the key things that you're going to see that maybe an LP might look at this offering memorandum and look at and be like kind of confused by cash on cash, an IRR, and a preferred return. Those are kind of three things that everybody puts out there. And someone that's new, well, what does that really mean to them? Like you said, the cash on cash is greatly affected by the cap rate. Those three items, could you just give a high level what they mean to an LP investor?
Yeah. So I kind of visualize my underwriting like top to down, and there are metrics to kind of measure each stage of the underwriting. So cash on cash, I see very much as an operational metric. So it basically says I invested $100,000 into a deal, and in year one, I'm going to get $10,000 back from the operation of that property, right? So it's producing cash flow. I'm getting $10,000 back. That is a 10% cash on cash return. And then hopefully I see that grow over the life of the property, so I can get an average cash on cash return for the whole period. Like I said, I definitely look at cash on cash a lot because it tells me how the property is going to operate. So if they're doing a big renovation, as I mentioned earlier, cash on cash might be really low in year one, might be 2 or 3%, right? So good to understand the cash on cash outlay. And a lot of investors will put that table in their OM so you can see that. But so cash on cash is that piece. The other one was IRR, right?
Yes.
So IRR, this one, if you ever try to calculate it manually, it's super difficult, but it's IRR is a rate of return, right? So it takes into consideration the time value of money. So what it does is it looks at all the money that you put into a deal. It looks at all the money that the deal generated either through operations or capital events like a refinance or sale. And then it looks at your capital return. So it requires a return of capital, your initial investment, and then it takes into consideration the time, the amount of time that went by. It basically discounts everything back to today's dollar. So long story short, it takes into consideration all the cash inflows, outflows of the property and the time required to generate that return to produce an IRR. So like I said, a lot of investors will present a 15% or 70% IRR. And then I'll make one note, like one that I like a lot, and it's very simple. It's just a simple ROI, but it's also called an equity multiple.
Oh, yes.
So I really like this one because it's using the exact same data as the IRR, but it's not doing the discounting process. So if I invested $100,000 into a deal and it has an equity multiple of 2, that means I'm going to double my money during the whole of that project, right? So for me, that's really easy to understand. I can see the equity multiple and know how much money I'm going to get out of this deal, right? So that's a 200% ROI, basically.
Thank you. Yes, that was one that I do personally always look at and completely slip my mind not having an OM in front of me. So thank you for that. That is definitely a really, really important one. It's the best high level way to tell the story, really.
Yeah, it's really straightforward. There's no funny business going on in that one. Discounted cash flow calculation.
Yep. As long as you can look back and make sure the numbers they put in are legit. Make sure you've gone in and you see that 2 equity multiplier, but everything, all those other red flags that we mentioned are kind of crazy. Well, there might be somewhere they're pulling some kind of funny lever, but definitely awesome.
Yeah, and I saw just for your audience, I did see a deal recently presented where it had a really great IRR. It had like I think it was 18 or 19% IRR. I was like, that's unheard of. How are they doing it? Well, they had an exit planned in 2 years. So IRR is very time sensitive. So their goal was to get in and basically get out right away. And that their cash on cash wasn't great, but the IRR was really big. So good example how it's very sensitive to the hold. People that hold properties for 10 years may have a lower IRR as a result.
And I guess that's where the investor can kind of look at, okay, how long do I want to put my money? Is this the right business plan for me? This goes back to them knowing the deal, knowing the business plan, and what do they want for their money? Would they rather have a higher multiplier and let their money sit there for a while, what do you think about when that comes to risk? That if you're going to have a quick sale, well, what's that market going to be into 2 years? Is that accurate? If that's counting on that sale, that could be a higher risk. But again, higher money. So it's all one of those things to ask yourself, what do you want to do with your capital? Does that line up with their business plan? So you do have to know what you as an investor want to do with your money before you can look at a deal and say, this is great, because this might be great for me. You can have my capital for 5 years, where someone's like, no, I want 3 the longest. So
and that's a really good point. We've been talking to our investors, and we're finding that a lot of our investors really just want the cash flow. They want to hold, right? Because there's an issue. There's a problem that happens if you get into a deal and they sell it in 3 years. You get your money and you get the return. That's great, but now you have to go find another place to park that money. And that could pose a problem, especially if you're trying to 1031, you have a short time window to find a new investment. And some of our investors are like, I don't want to deal with that. I just give me the cash on cash, give me the depreciation, and let me run with that, right? So it depends on your strategy as an investor on which metrics you really focus on.
Good point.
Yeah. This has been great. It's been really informative. Craig, if our listeners want to learn more about you, what you do, they want to reach out to you, is there a way they could get a hold of you and get in contact?
Yeah, I have I have a few websites. I would say, yeah, you can reach out to me either at Vivid Invest, like vividinvest.com. You can contact me there, or my underwriting website is the MFA, like Michael Foxtrot Alpha, underwriting.com. You can click the contact, that'll come right to me.
Yeah. Well, we like to kind of wrap up each of our podcasts with a kind of a thought-provoking quote of the day, kind of discuss it. So Tamara has three quotes with her that she's picked out that are kind of pertinent to what you do. Could you pick a number 1 through 3 and we can discuss it?
Okay. Number 1.
Number 1. So number 1 is in learning, you will teach, and in teaching, you will learn. And that was by Phil Collins, actually.
Wow. That's awesome. So am I supposed to comment on that?
Well, yeah, if you'd like to comment, like how it, like, resonates with you, or,
Kind of sounds like what he's doing.
Right?
No, actually, it does resonate with me. My personality is like, I love teaching. I love talking about this stuff, obviously, right? And I love teaching people like the ins and outs. And I definitely love data, right? And I think it's so cool that you could take all this data and you could tell a story with it, right? You can find insights and tell a story. And I love teaching people how to do that. And I think it's super cool to see the light bulb go on.
Uh-huh.
So I think that definitely resonates.
Yeah, I try to learn something every day, and then that's where in like telling and helping others, like sharing knowledge, you do end up like learning something yourself, or just about the person maybe, or even about something else.
Yep. I have a call right after this where I'm going to teach somebody how to underwrite. And, like you said, it's like you learn through teaching as well, because this guy's really sharp and he asks a lot of hard questions. So it definitely gets me to learn.
He wants to engineer that box, huh?
Yeah.
That quote really makes me realize too, I think a lot of times when you're teaching someone something, you tend to learn a lot about yourself. Like, oh, okay, like if that's for me, I realize things like about myself, I should improve in this way or in that way, or how different things resonate with one person versus the other. But it's definitely, I think, one of the best benefits of teaching is what you can learn yourself. Mm-hmm. Like in this podcast, we're trying to help LP investors learn, and we have super amazing guests like you come on, and we end up learning a ton of stuff ourselves. So it's always great to have such knowledge.
Yeah, thank you for having me. This has been great.
Yeah, thank you.
Well, I mean, I think in conclusion, really, this episode has been really fabulous. We thank you so much for really pointing out all the different things that our guests and listeners can look for, because it is super crucial to have those bullet points. I think, they should, our listeners should take away the fact that they should know what they want to do with their capital. What do they want to achieve? Maybe re-listen to this again, write down those little red flags that you should look at. And don't be afraid to ask the sponsor the hard questions, because you have to do your due diligence. And if any good sponsor, they'll know their numbers and they will be more than willing to share it with you, because that's the facts, that's the business plan. And the more they share with you, the more solidified it will be. So if ever they don't want to share, then that would maybe be a little red flag. So we just really want to say thank you to not only you, Craig, but to our listeners for joining us here at the round table. And if you ever want to learn more, you can always check us out on Instagram, Facebook, YouTube, and of course, visit our website at The Real Estate Women. But I hope you listeners, had as much fun as we did here talking about this. So thanks again. And thanks so much again, Craig.
All right. Thank you for having me.
Thank you,
Craig. Bye, everyone.
The information contained in this podcast is for educational purposes only. We are not licensed professionals and do not give investment advice, tax advice, or other professional advice. Please consult a licensed professional before making any financial decisions.